Yeah. Good evening, viewers. You are welcome to this School of Asset Management. My name is Atanlogun Babjide. I'll be the one to anchor the section of forex trading. So this section, you will learn how to trade the forex market practically and how to generate signals for yourself. But before we go to the practical class, we have to go through some of the basic things that we need to know, most especially the theoretical aspect of it and the highlight of what we're going to study in this school has been displayed. So these are the highlights. We're going to study Introduction to Forex, why Forex, basic terminologies, understanding the currencies, understanding the market interface, fundamental analysis, technical analysis, value flow trading strategies, market sentiment, the use of expert advisor, and so on. So we also need to learn the reason why people fail in the forex market, as well as the way forward. We need to talk about the broker and the roles they play. So on this note, we're going to start from the first slide. What is forex market? I define forex market as the buying and selling of the world's most valuable currencies. Forex market is the buying and selling of the world's most valuable currencies. Though the forex market is the world's most exciting and dynamic market, with a daily turnover of over $4 trillion traded every day. And it is also the largest financial market in the world. So the word FX means foreign exchange. That means if we're talking about the foreign exchange, that will be a deal between two different countries. For example, you may sell your naira to buy dollar when you are traveling to the United States. Let's move on. The forex market, I want you to know, is divided into two. We have the local one, but this one we are going to talk about the online forex market. Online forex market simply means that you take possession of the actual physical currency. That is, everything is being done online. You open and close deal and make either profit or loss online. So that is just the brief summary. Why forex? Why do we need to trade the forex market, most especially the online forex trading? 1. Accessibility. Forex market is easily accessible. It's no wonder that forex market has the trading volume of over $4 trillion a day. So anyone needs to take part in this action with just your computer, your device connected to your internet. You will take part in it. Number 2, it's a 24 hours market, whereby the market runs 24 hours. Most of the people that trade currency Monday to Friday, so you can enter the market Monday to Friday, so without any restriction. So just be doing your own on the internet 24 hours. So narrow focus, unlike the stock market, which is a smaller market compared to the foreign exchange market. The forex market revolves around or more less 8 major currency pairs. When we're talking about the forex market, your focus is major on a particular currency pair for those people that normally trade currency. So it's not that you can divert. With just one currency pair or two, you can make any money that you want to make. Liquidity. Liquidity simply means this market can be converted into money, liquid cash. It can be converted to cash. The digital currency that we're trading, though forex is being done digitally. When you make your money, it is being converted digitally, straight, without any restriction. Okay, yeah. So, also, the market cannot be cornered, because you can't just, this market is not prone to manipulation. So you can't manipulate the forex market, and even banks do not have enough pool or enough control. Nobody can just say I'm in total control of the forex market. So you don't have control over the market. The market is being run by itself. So anybody that wants to take part in the forex market, you don't have a total control. So that is one of the beauty of the forex market. That's one of the beauty of the forex market. So increased leverage. Leverage is when you borrow money so that you can use it for smaller investment to get a greater yield. Unlike the stock market whereby you have an offer of 1 to 2 leverage, but with forex you can have 1 to 100, even 1 to 500 leverage. But note that the higher your leverage, the higher your risk. So those are the things that you need to know. Profitability. Sincerely, forex market is very, very profitable, though it's one of the most risky business in the world, but it's very, very profitable. In forex market, profitability is expressed in a number of ways. Number one, unlike most financial market, forex market allow you to start trading with a very relatively low capital. You can start with a very small capital when it comes to the forex market. Number two, leverage trading. Leverage trading lets you open a position for tens of thousands of dollars while you are investing as low as maybe $50. Yes, because of the higher leverage, the higher your leverage, the more the number of trade that you can place. Just like somebody that has you have $1,000, another person has $100. You can decide, if you have a higher leverage, the same number of trade that the person that has $1,000 can place, you can place that same trade. So what is also unique about the forex market is that any short movement is an opportunity to trade. That is, what they mean by this is that forex market, you can win on both sides. That is, when you move in the buy direction, you win. If you move in the sell direction, you also win. So you can win on both directions. So that is one of the beauty. That's one of the beauty of the forex market, because you win on both sides. So, caution. You should always be aware of the risk and never risk the money that you can't afford to lose. Wow. When we compare and contrast the forex and the stock exchange, as well as other financial institutions, what I can just tell you is that Forex market is one of the most risky business in the world, and is one of the most profitable business in the world. That is why we're in that we need to mentor you on how to trade on a very low risk. So let's move to the next slide. Basic terminologies. These terms, there are some terms or terminologies that we use in the Forex market, but you cannot find it in the normal literary language. The first one is ask. Ask or asking price. Price at which broker or dealer is willing to sell, and the price at which you can buy at that same offer. Balance. The value of your account, including unrealized profit or gain. That is what it means on open position. When you have not placed a trade on your account, what you have there is balance. Bear is a market condition where the sellers are more than the buyers. When we talk about the bearish market means the selling market, the sellers. So we talk about bid. Bid is price at which broker or dealer is willing to buy, and the price at which you can sell. Bid means selling price, while the ask means the buying rate. So bid ask, or what we call spread. Spread is usually the distance or the difference between the bid and the ask. For brokers or for professional traders, they always prefer a system whereby the spread is very, very low. When we have a very low spread, you can easily make money from a very low spread. So bull, market condition, is a market condition whereby the buyers outweigh the seller. That means a bullish market is a market whereby the buyers dominate, a buying market. So when we talk about bullish, a buying market, we also talk about drawdown. Drawdown in the real language means drawdown when you are losing, when you're on a loss in the forex market, you're trading and you're making a loss. You don't say I make a loss, you say you have a drawdown. You have a drawdown. Equity means when you place your trade, equity is balance plus or minus your present position. You are using your equity to trade, you are not using your balance. We can have a situation whereby you are given a bonus. So this bonus will be added to your equity. When you place a trade, either profit or loss, what you are using to trade is equity. Free margin, the amount in your account available as margin for a new position. That is what we call free margin. Free margin is equal to equity minus margin. Fundamental analysis. Micro or strategic assessment of where a currency should be trading based on any criteria except price action itself. Fundamental analysis, we're still going to go back to it during the course of this training. It's just like when you're using an economic situation of a particular country, which also affect their monetary policy when you are using it to trade. So that is leverage. We have talked about the leverage, that like an amount expressed as a multiple by a notional amount traded exceeding the margin required to trade. That is, when you have $100, another person has $1,000. You want to be trading as if you have $1,000. The number of trade that the person that has $1,000 will place, that is the one that you place. That is if you have a higher margin. And I told you that the higher your leverage, the higher your risk. So let's move. Limit. Limit is an order to buy at a specified price when the market moves down, so that the price, or to sell at a specified price when the market moves up to the price. Now, this limit is like a pending order. So when we're in the practical class, it will be very, very clear. So let's move. Okay. Now, we've talked about liquidity, the action of a volume and activity in the market. Another terminology is called long. Long means buying position. We also have another term called short. That means selling position. Margin, the amount that is needed in your account to open a position, is called margin. Margin call, a requirement by the broker to deposit more fund in order to maintain an open position. This margin call, I can explain it as when you have a drawdown and you draw down as reach a particular threshold, so that your account will not burn off, the broker will give you a call, a margin call, that deposit, make sure you deposit a particular amount so that you can still retain your position, so that you can make more money. That's what we call the margin call. So market order. A market order, an order to buy at current ask or to sell at the current bid price. That is what we call market order. You always see it displaying on the market, that a market order. Pips, the smallest incremental value a market can move. Pips simply means at a particular price, when the market moves, pip is just like the SI unit of measurement of price on the forex market. Because, just for example, Euro USD moves from 9.90.15 to 90.16. So he has moved 1 pip. So, and your pips is also determines your profit, because pips multiplied by lot size is equals to profit. Quoted price is the most recent price at which a security or a commodity is transacted. That is the current price. That's the meaning of quoted price. Short means selling position. Short, selling position. Stop is also called stop loss. This particular term, we can stop a market while you are trading. Maybe you decide that maybe the market is on loss, or maybe the market is on loss. You can decide to stop a particular trade because of that. or you set a stop loss order. It can be an instant execution, or it can also be a pending order. Swap rate. Swap. When you carry a trade overnight, maybe you are placing a trade, you could not close your trade overnight, the broker, they will remove swap. They will charge you for carrying over a trade. Take profit. A take profit is an order to claim a predetermined profit made in case of market reversal. When you want to place a trade, the first thing you need to consider is, okay, how many pips do I want to make? Where do I put my take profit? On which price level do I put my take profit? So when you put on a take profit order, immediately the market touches that price, it will take the profit for you, either when you are on the system or you are not on the system. So that order that you have set is called a take profit. A take profit can also be an order that you can execute directly. It can also be an order that you can execute directly. Maybe, oh, this price, I've gotten enough money. Okay, let me close the trade. You can close the trade. You can close the trade straight away. Let's proceed. Technical analysis is just a system whereby you combine some technical indicators. We have some technical indicators on the forex market that they are really working fine so as to study the market, and we make use of them most often together with the price action. Price action, because a technical analysis is very, very important. So we are going to get all those things during the practical class. Let's move. So, understanding the currency pair. Understanding the currencies. What do you trade? In forex trading, you mainly trade currency which are always traded in pairs. What we're talking about now is that when you want to trade, you can't just trade only one currency. You have to trade them in pairs. That is, two currency must be involved. That means two countries are involved. The currency of one country versus another currency of another country. So that is why we need to trade. We trade forex in pairs. So in general, we have the 8 most traded currency in the world. The first one is US dollar. The second one is euro, Great Britain pounds, Japanese yen, Swiss franc, Canadian dollars, Australian dollar, New Zealand dollars. All these currency pair, they are the most traded in the world. So let's move to the next slide to see their pairs. Now, when you're looking at this series now, looking at this table now, these currencies revolve around 14 main currency pairs. And the first table that you are seeing, these ones, they are called the major pairs. Why this one? They are called the cross currencies. Now, in a pair, in a pair, in a currency pair. The first currency is called the base currency. That is in this situation now. That is in this place now. Like Euro USD now. Euro is the base currency, while USD is the paired currency. So that is the way it is being arranged. So it is the base currency that determines the profit, not the paired currency. So let's move. Now, when buying or selling a currency pair, each pair has its own bid and ask rate. For example, Euro USD. You can see that in Euro USD, sell Euro USD at the bid rate of 1.2917 or buy at the asking price of 29.18. So that is the way it's being arranged. So when we get to the practical class, we'll have to go through that again practically. When you buy a currency pair, you are always buying the base currency and you are selling the paired currency or the counter currency, vice versa. What they are trying to say is that when you are buying the base currency, automatically you are selling the counter currency, which is the paired currency. So at the same time, so who trades? Who trades? Who are those parties that are involved in the trading? We need to know that so that we can know what we're doing. There are two parties involved in online forex deal. You as the trader and the market maker. A market maker is a company that facilitates trading by offering an ask and bid price on a currency, literally making the market for traders to trading. Individual forex trader like me and you can make up the fastest growing segment of the global forex market. The other players include the interbank, which is mostly made of the largest commercial banks, security dealers, and after which we have the small banks and multinational corporation. What we're trying to explain in this place is who are the people that are involving in this activity. This forex activity, it's not just going like that. There are some parties that carry out that kind of activity. So those people, you as a trader, the market maker, we also have interbank. Those are the people, those are the banks. You know, remember that forex trading is even a World Bank project. As long as the banks and all the security company remains, so also forex will remain. Let's move to the next slide. When to trade. When to trade. Because forex is truly global market, you can trade 24 hours a day, 5 days a week. As one region market days end, the next region market begins. This means you can trade on any region news as development takes place. This means that you can theoretically trade forex non-stop from 2100. Let me just summarize this one for you. We have what we call the World Trade Centers, which they opened in different countries. So according to this analysis, we're going to know when that is the trading sections in relation to Nigeria or maybe other countries, so that you can know when you are supposed, when you are in Nigeria, there's some country whereby when we're in the morning, they will be in the afternoon. So we have to consider all those things why we want to trade the forex market, because it's a global market. So let's move. The time which two sections overlap are most exciting, as it's then that you can find high volume being traded and maximize volatility. What we are trying to explain in this place is that the world trading centers, they opened per section. So let's take, for example, now London Open is between the hours of 8 a.m. between 8 and 9 a.m. Nigerian time, and it ended around let's say it ended around 1, 2, 3, 4. So before it end, New York market opens between 1 and 2. Why the Sydney market the New York market open between 1 and 2 p.m. in the afternoon, Nigerian time. Why between 1 a.m. and 2 a.m. why the Sydney open? Sydney is in Australia. So why also between that same time, Tokyo in Japan, they overlap against each other and they also open at the same time. All these trading sections, whenever they open, you usually see the volatility of the market is always very high. Let's say you want to trade Great Britain pounds and USD versus USD now. So when you get to the market at 8 a.m. Nigerian time, between 8 and 9 Nigerian time, those are the times that you can maximize a very high. That's when you will see a very high volatility. You experience a high volatility while you are doing that. So that even if you miss the London section, what about between 1 and 2 in the afternoon? You just go there, log into it. You want to trade, the New York, that's United States of America. Okay, I can pick USD JPY or Euro USD. I can trade it, so that each of these sections, that is when you can maximize like high probability, so that you can see so many pips to cash. Yeah. Back to fundamental analysis. Fundamental analysis is defined as the study of a country's economic and financial performance in order to determine the fair market value and future direction of its currency. Fundamental analysis focuses on the factors that determine the exchange rates, such as countries' economic health, political stability, and environmental events, and how they influence the value of their currency. The fundamental analysis is the use of an economic news to trade the forex market. Let's take, for example, a country where they have a political instability. You should know that their currency will be very, very weak. So you can take that advantage. Let's take, for example, any country that has maybe a natural disaster like maybe earthquake. People will run away from that place. So definitely, if people run away from that place, there won't be activity in that country. So when activity is not in a country, it's not carried out in a country, definitely the economy will run into problem. So we can use that advantage, just like the period of COVID-19 where they locked down the whole of Europe. You can see that the euro is very, very weak. So that time people just sell. You just place a sell. So the currency will be becoming weak, And you can take advantage of that. That is just the basic principle that fundamental analysis is talking about. You trade the news, trading of the news. So also you can get all this information. Maybe during the practical aspect, I will expose us to where we can get all those news, all those information about the economic news, so that when we are online, you won't say, oh, I analyze the market and the market is expected to be selling and is now buying. Maybe there is an economic news that is affecting the market. So forms of fundamentals, economic indicators, and data release, speech, all those press conference, meetings, when they hold them, they are also an indicator that will affect that currency positively or negatively. Or the correction between currency, oil, and gold. You know that it's not only currency that we trade, we also trade commodities like gold, we trade oil. So when we get to the practical class, we will get some strategy that we use. Technical analysis. Technical analysis is the study of historical price movements by using charts in order to predict the future price movement. Charts are other various technical analysis indicators can be applied to them as an essential tool for traders. Technical analysis simply help you to identify entry and exit point for trading. Yes, technical analysis is the use of historical data. Maybe for example, maybe in 2010, there's a place where price got to. Before you know what is going on, we have some technical tools that we can use to determine all these things. We have some of these tools. So during the practical section, we'll be mentioning these technical tools one by one, so that we will know how to apply them per time. So, okay. Let's move to the next slide. So, charts is a major technical tool, because charts is like a pictorial representation of all the activities of of people, transaction done on the forex market. So we can read the charts. So, and one of the best technical tools in the forex trading is charts. A forex chart is a graph representation and the movement of market price during specific time period. There are many kinds of charts, each of which help you to visually analyze the market. Visually analyze the market condition, identify behavioral pattern, and assess and create forecast to reach a conclusion about the future price. What we are talking about is that it is the chart that you read. When you read a chart, you should know where the market is going to. You should know the pattern that the market is forming, so that we can use it to predict, so that we can use it to forecast what we want to do next. So this is an example of a chart. This one is going uptrend. So this one is what we call the candlestick charts. So, and I believe that very soon we will all be familiar with all those things. Another one, just take a look at the type of chart that we have: the bar stick, the candlestick, and the line chart. But the commonest one is the candlestick. And this candlestick is a pictorial representation of all the activities on the forex market. It is on this candlestick you can put all your technical indicators. There are some indicators that are on the MetaTrader platform. So we also have the line chart. We also have the bar chart, which have so many features: the high, the low, the close, the open position. So the candlestick. This candlestick, I will talk more about this candlestick because that is the most common that the 21st century traders that they use. The candlestick chart is similar to bar chart, as also contains certain interval like the open, the close, the low, and the high prices. The main difference between the candlestick chart is that the candlestick has a body which represents the range between the open and the close position. So we talk about the top of the wick represent the highest price. So why the bottom of the wick represent the lowest price. So we move. Yes. This is where we're going to stop, and we're going to continue in our next class from price action. So thank you very much. So if you have any question, so you can ask the one that you don't understand. Thank you.